G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and each episode we bring in what I call best in breed. And today's guest, I'd say, is the epitome of best in breed, a name that's synonymous with investing in property and also podcasting as well. So we've got the best of both worlds today. And I'm thrilled to introduce to you the founder of Property Investory, Tyrone Shum. Welcome to the show, Tyrone.
Thanks so much, Aaron, and a pleasure to be on. And thank you so much for inviting me on as well. I'm excited to be here.
Mate, not at all. Not at all. It's our privilege, our pleasure, and the time that we've got together, I really want to kind of pull back the Tyrone Shum story and talk through a little bit about your journey into property, a little bit about what you're doing at the moment, and so many exciting plans that you've got that I want to kind of share with us. So to kick off, do you want to take us through the Tyrone Shum story and what I call the 3 Ps? So a bit about yourself personally, a bit about yourself professionally, and a bit about yourself on a property front as well.
Thanks so much as well, Aaron. And I guess, maybe just to give a little bit of listeners' background of who I am. I'm Australian born. I've been bred and born in Australia all my life. But I'm sort of third generation Chinese, and my parents and so forth have all come from a hardworking middle class, I guess you say, background, and we've all been living in Australia for a very long time. But yeah, I guess personally, I've grown up in Australia. I've also been working as well in various industries, from the building industry to, I guess, IT to universities. So I've had a very, very wide variety of, I guess, experiences. Not only that, I've also worked, run my own business as well too, in terms of that. And I guess had so many great experiences interviewing amazing experts and property investors and property developers across Australia as well. So yeah, that's a little bit of my background, and it's been fun to be able to do this and be happy to be on this podcast too.
You mentioned about property, and it's been part of your journey. And I find that you mentioned IT. A lot of people that moved into the property space actually have kind of cut their teeth coming through IT, isn't it? It's kind of it's been a really good platform for a lot of people. I guess they have a very, a very mechanical mind, and they go, look, follow the numbers, follow the process, follow the pattern here. And it makes for great investors that are coming out of IT.
Yeah, no, absolutely. I think that's the interesting part about, I guess, investing. It's not just for specifically logical minded people or people who've been I guess inherited a lot of money and so forth. Property can be for anyone, and I've interviewed so many people in the past who've had absolutely nothing, and they've built a multi-million-dollar property portfolio just from pure perseverance, consistency, and hard work. And they've been successful in the sense is that they've just put a plan in place, stuck to the goals, and just consistently persevered and got to where they are. So I think that's the interesting part that you mentioned, that is that I do meet a lot of investors who also come from IT background, just like myself, but it doesn't necessarily mean that you guys are always going to succeed. It just means that we have a different approach on how to get into property. And I guess from a professional background, as you mentioned, I kind of went to a school that also allowed me to be able to experience all the different type of opportunities to be sort of all-rounded. So my school wasn't necessarily just academic, but it also allowed me to play sports, but also allowed me to do co-curricular activities like Duke of Edinburgh and all cadets and all that kind of stuff, and even part of music and orchestra and so forth. And that kind of allows you to have an all-roundedness, to be able to take those skills, which I've developed over the number of years, and then apply into property in the sense, and also to the podcasting world as well too. So
it's called like softer or rounder skills, isn't it? Because you got the hard skills, which is like your academic side, but you're saying you got those, you picked up those softer rounder world, street smarts as well.
Yeah. It's I'm very, very fortunate. I mean, like, as I said, my parents were from a reasonably well, upbringing, and they sent me to private schools. I was able to, I guess, achieve quite a lot when I was at school and also university, and they, provided a good foundation to where I am. But ultimately, after leaving, say, university, and I'll tell you a story about what happened. In the first year of university, I actually flunked out in 2 of my subjects, which meant that I was, failing. and going from a private school, all boys school, where, you achieve great marks, you do so much, and you've kind of been almost spoon-fed pretty much. You're told what to do, you do this and so forth. It's a big shock to your system, and you go, man, how come I failed in this? And it kind of allowed me to realize that, you need that kind of, I guess, failure to be able to change and look at different ways, because I was like going, man, this is the end of the world. Am I going to be able to survive? And yada, yada, yada. Being a teenage, university student, not much money and so forth like that. You go, oh, man, there's got to be more to life. And that's when my auntie actually gave me The Rich Dad Poor Dad, a book by Robert Kiyosaki. And I read that book from literally front to cover to the end of the book within the night. And it just went, wow, there's 5 basic principles that really changed my perception on life, and also on money as well. And that's where it kind of started my journey to initially start looking at different opportunities to be able to invest and also, run businesses and so forth. And that's where kind of property sparked my interest. And I guess that journey has led me to where I am, because as I said to you earlier, it doesn't necessarily mean that you have to be successful at school or university or your work to be able to invest in property. Anyone can get into it at any age and any time.
Yeah, beautiful. So take us through your journey. I mean, you mentioned you kind of come from book, inspiration, motivation to then, the trigger point is then taking some action. And take us through your journey. There's, highs and lows in every property investor's story. So take us through yours and what your journey's entailed as well.
Yeah. So after reading the book, it kind of triggered me to go, okay, what are the opportunities or the ways I can actually make money? That's what a young kid of my age, I was probably 19, 20 going.
And we're always looking for a shortcut at that age. Yeah,
exactly. You want to just make millions of dollars overnight. And it's like, yeah, what do I got to do next?
And this is pre-Instagram days, which means we had to do it like the hard way, right? So
that's absolutely right. And I guess back then when you think about it, without the internet, without the computers that we have and then technology you literally had to go to the library and pick up books and read. You had to ask people, had to, seek advice from people who had already been there, done that. And I guess what I did firstly was I had a chat to my auntie, and she gave me some really, really wise words is, don't rush into things. And obviously being a young, impatient child, I wanted to just get straight into something. And she said, look, you should probably just read a little bit more and find out a bit more about what the opportunities are. So I guess I picked up a few books, started subscribing to a few magazines like the property investment magazines and so forth. Not only that, I also did a little bit more research into businesses. And at that early stage, there was something that sort of resonated with me when Robert Kiyosaki talked about finding passive income, finding ways you can generate positive cash flow from whatever you're doing. And it didn't necessarily mean that was in property, because at that age, I didn't have much saved up. Maybe I had about a few $1,000s in the bank, but it wasn't enough to be able to put a deposit down to buy a property. So instead, I looked at starting up some businesses. And my first business that I started up was a vending machine business, because I thought passive income, I don't have to.
I laugh because I've done the same as well.
And that started off okay. I went across to some of the family friends who had businesses, and I said to them, "Can I just put a vending machine in your factory and a few locations?" And they said, "Yeah, no problem. We'll give it a go." So every week I'd go in, pick up some money, and just turn things over. It wasn't, you don't make very much in a vending machine. You've only got one or two. You need to have, a lot. And that's where the power volume comes into play. So it kind of disheartened me. I thought, I'm earning a few dollars a week. I'm like, oh, is it really worth my time driving in, changing all that and so forth?
Ordering your stock, getting it in there. Yeah. Dealing with gem coins.
Yeah. Picking up your coins and going to bank deposit and stuff like that. But it taught me a valuable lesson, because I guess you have to try to know. If you don't try, you always wonder what's going to potentially happen. So this is where the exploration path was happening, because I was still at uni, full-time uni, going into my second year, repeating the same subjects that I failed. But at the same time, as a uni student, you sometimes have a little bit extra time. So you go and try and explore different things. So I started doing all these different things to learn. And I did vending machine business. I started a dragon boat business. I also went into renting a property and then subletting out to tenants. And that's the first foray really into, I guess doing property itself. And that kind of led me into a lot of different learnings as well. But I think, long story short, just to sort of explain to you, I had to try so many things. And in order to actually get to where I am now, it was all about experimentation. As I mentioned, there wasn't the internet as we have it today. You had to actually go out and try, speak to people and learn from things and really just get hands-on. Whilst at the same time, making a lot of mistakes along the way.
Perfect. I mean, speaking of mistakes, that's probably one of the big ones that we do speak about is there's no shame in making mistakes. In fact, that's what makes people, and especially investors, stronger and better. So take us through. I mean, you probably worked with a number of investors yourself. What are some of the mistakes that you've seen that you go, hey, look, this is a common pitfall. These are the ones that we kind of see pop up time and time again?
I'll tell you, the typical one is buying on emotion. I've done it myself, and a lot of investors have too. It might be like at a barbecue and you have a chat to one of your friends, and they're talking about the latest stock, for example, on the share market, and said, I bought that one. I made $10,000 overnight, blah blah blah. And you go, yeah, that sounds great. I'll invest in the next one. Next day, you buy it, and then a few hours later, it crashes, and you go, oh man, I should have listened to him. It's the same thing with property. You might be talking over a barbecue, and they say that's the next hottest suburb because it's grown so much. But looking in hindsight, you go, wow, if that suburb's already grown, then the chance of it growing further is usually very minimal because it's already taken off. And I think that's the thing we've learnt, and I'll share with you a story, from personal experience, is that when we had, my father had a property in particular that he purchased at the end of, or towards the end of the 2002 property cycle, I think it was. And at the end of that boom cycle, he was convinced that this particular property was going to make him a lot of money. He bought a beautiful apartment down by Harbourside, down by Darling Harbour, King Street Wharf, beautiful views,
Great spot.
Great spot, and that was at a particular time in the boom cycle. That meant that he didn't know when the boom was going to end. No one did. But unfortunately, at that point in time, 5 years later, when he purchased it, he couldn't hold on to it because he couldn't afford to pay the interest on that one. And the reason behind that was because he overpaid for the many years. Like, I guess, unfortunately, 5 years later when he sold it, purchasing at $800,000 5 years ago, sold it for $690,000, meant that he made a huge loss on that one just for that one property. And that goes to show that he went and bought on emotion because the person who sold it to him was a very slick salesman, drove up in a nice BMW 5 Series, dressed up all really smoothly and saying the world to him. And he just literally bought on emotion and said, I think I'm going to do really, really well. But, when reality hit, he wasn't able to service that loan for too long. And if he only was able to keep that property for another few more years, it would have paid itself off immensely, twice its value. So I guess the lesson to be learned is necessarily just don't jump in and buy something that someone says that sounds great, but do your due diligence first, speak to a lot more people and educate yourself first. That's one of the biggest mistakes I've heard and learnt from as well.
Is there also another lesson there where it's like the right time to cash out? And like, you mentioned it holding it became physically or financially a bit harder, but also we have to tell people there might be a period of pain, but maybe holding it is a double-edged sword because it couldn't even drop further, you don't know, or could bounce back as hindsight tells us sometimes as well. So kind of when you're confronted with that situation and saying, look, I might sell it because it's losing value, it's a bit of a dud, or it's expensive to maintain. Have you weighed into that conversation or going, look, grind it out and it might be worth it on the other side, or just cut it loose and move on?
Absolutely. And I'll tell you another story. I purchased a property. I guess I was looking for cash flow positive properties. You buy a property for say maybe $100,000 and it'd probably return you maybe $230, $250 a week, which is really, really positive cash flow. But my mistake was I bought in a regional town, and the regional towns have very, very slow growth, particularly in the central part of New South Wales. And I think at that point in time, I was like, okay, if I can buy 5, 10 of these kind of properties, it'd be a nice cash flow to be able to sustain a nice lifestyle. But realizing that it's not the way to move forward, because once you've tied your cash in there, you can't get any growth out of these properties. You can't move on to the next property because you're tied up. So I think that's the thing. You've got to do your due diligence and research behind this, because ultimately, some properties, yes, you can hold on to. If it's in a major capital city, you just wait long enough, things will move. And I've seen it time and time again. Those capital cities that you buy in, whether it be in Queensland, Victoria, Sydney, very high demand area. There's great locations there. You give it some time, even if you hold on for 10 years, 15 years, and it doesn't move much, which is very unlikely, you'll definitely see there's a reap of benefits because population grows dramatically over that time. Whereas in regional towns, especially the ones that are sort of more central towards Australia, very, very small population, those are the ones that I would definitely not hold on unless your strategy is to buy lots of those for cash flow purposes. Because when I purchased that property for the first time back in, I think it was like early 2000s, I held it for about 5 years, and literally I purchased it for about $105,000. 5 years later, I sold it for $106,000, literally $1,000 profit. And you go, wow, I could have held and bought a property in Sydney for that same amount of time and it would have doubled. I was looking at properties in Ermington, Sydney, and I remember picking up, those renovated or the unrenovated DIY kind of properties for about 320,000. Now those properties are worth over 1.5 mil because they're by the water and so forth. So you can see it depends on the location and it depends on the situation that you're in as well.
Yeah. You touched on something really important that I want to ask you about, which is what I feel investors run out of, two things, or one or the other. They run out of equity, which means, like your point, the property hasn't grown in value. They're getting frustrated. I can't pull any equity out to then go again. Or they run out of borrowing capacity. So maybe the cash flow on them aren't so great. Maybe they've hit a wall with their own personal incomes and now they can't borrow more with the bank. So when you've seen those two hurdles and what I call common hurdles or barriers, how have you yourself been able to sidestep those? How have your clients or people that you've worked with been able to kind of break through that barrier? One of those two things holding them back.
Yeah, I mean, I've seen it typically in a lot of people who've interviewed with stories like that. I'll probably give you an example. I remember interviewing a very successful investor who's had probably close to about 40 properties. And what happened was he was still working in a full-time job when he purchased his first 12 properties from memory. And at that point in time, his level of income was pretty much at rock top. They couldn't do anything more than that. And the banks wouldn't lend him any more money. And he literally got stuck at that point in time because he couldn't service the rest of his loans and so forth to be able to move to the next, part. So that is an example of somebody hitting at the top level. So he basically spoke to his coach and his coach said to him, look, earn more money. And, you initially go, I've got a secure job. I don't want to move out. What I have to do that. It's a fear, But, he took the plunge, started his own business and waited 2 years because it usually takes 2 years for the bank to actually reassess you. And that's what he did. During those 2 years, he actually just focused on building his business and turned into a very, very successful business. And essentially after those 2 years, he went straight back to the bank and he started to basically, buy more property. And now it's up to almost 40 properties. So it's a matter of time, I guess you can say, and looking for opportunities to increase your income. And some people might just say, increase your income by getting a pay rise or whatnot. And that's fine and all, but that may take a while. And sometimes you may need to do a side hustle or start up a business or something to be able to generate that. But you need just that patience to be able to sort of overcome that hurdle, because the more income that you generate, not only from your business, but also your portfolio, it will be able to allow you to service that and then help you, overcome that kind of roadblock if your servicing is an issue. Now with equity, I guess, from what I've experienced and spoke to a lot of investors out there, is that you can manufacture equity. Sometimes it's not that hard. It's just a matter of what you see differently too, because you just got to look outside the square. Like, for example, I had a property down in a sort of a really well-known regional town of Victoria. And that particular area is by the water. And I purchased this commercial property there for the intention to really just to bring more additional cash flow to my portfolio. And luckily for me, it already had 5 sort of separate, I guess, you say units in there. It was actually, 3 retail shops down the bottom and 2 units up above. Now, I purchased that just really for the cash flow purpose. I didn't think much more about it, but I sort of knew that when the agent told me there's development potential, I just kept that at the back of my mind. When the time was right and when I needed to actually draw more equity out of it, I went, okay, opportunity here. Let's see what we can do to develop it. So I reached out to a town planner, had a discussion with them. And essentially we were able to develop 2 extra townhouses at the back, add an extra unit at the front, renovate all 3 of them. And within a short period of time, within about 6 months or so, I was able to draw an extra, say, $200,000 out of that because of just thinking outside of the square. And that's the thing, like you may have a hidden diamond inside one of your property portfolios that you may be able to do something with it, whether subdivide, add a reno to it, add a granny flat, whatever. But if you think outside the square, there's opportunities to be able to increase the potential of your portfolio to draw out more equity if that's what you need to do to buy your next property.
Excellent. No, it's super helpful, mate. And this is what we talk about when someone's tread that path and been there before other investors, is passing that baton on, that knowledge on, going, yeah, you may hit these, you may hit the wall here. Here's what you need to do to get around it. And thanks very much for sharing that, mate. And one of the other questions I had for you was, as you've become more sophisticated, your portfolio has grown, for example. I know I've been reading about your work. You've now moved, I guess, into a different style of funding, for example, and different style of projects. Can you take us through what's, I guess, your next iteration and what your focus is at the moment as well?
Yeah, it's a really, really interesting space that I'm playing in. I'll sort of term it and call it sort of alternative strategies. I've been experiencing, because I've interviewed over 300 investors and guests on my show for a while, I've seen so many different ways of actually building a portfolio or investing into property or doing development and so forth. And that's given me a lot of great insight into what the different strategies are. They could be from buy and hold all the way to property development, and I think everyone has its own, runs their own journey, and being able to do that, as long as you have your plan and your goals and your strategy set up in place and know where you want to head, you try and execute that strategy. But what I was noticing as over all these number of interviews, a lot of the people who have been successful in, say, for example, the buy and hold strategy has taken between 10 to 15, anywhere up to 20 years to be able to build their wealth, to that level. And don't get me wrong, buy and hold still works, but it will also require a bit of a change in the way it's done, because let's just take, for example, average property prices back maybe 10 years ago in, say, Sydney and so forth were anywhere between 300 to 500,000. Nowadays, we're in 2022. You're not going to be able to find those kind of prices. You might be lucky to find one in an apartment, but it's very rare. Average property price anywhere between $1 million to 1.5 million, which is substantial. So going back then, the banks were a little bit more lenient. They were able to lend you a lot more, and you could buy a lot more. And hence the reason why a lot of investors who I've interviewed in the past have had large portfolios, because they've bought a lot of these properties and they've doubled in value and so forth. But if you're just starting out and wanting to do a buy and hold strategy, which is great and all, it may be a bit more challenging because, one, the values of the properties have gone up so much, so you might not be able to buy as much as you used to be. And to even get 5 properties, you need to have some form of servicing power to be able to get, say, 5 mil or 6 mil worth of servicing. I mean, you can still go and buy interstate and get things for about $500,000 or so forth, but you still will need, to service all that as well.
And then that becomes the buy and hold strategy as well, right? Which your early points is lower price points. You need time for that growth to then kick in as well, isn't it?
Absolutely. And the challenge we all face is wages haven't moved much up at all. And because of that, the banks are also stringent, and your borrowing capacity could be limited due to that, which is hence the reason why I started going out to look for alternative strategies, because I got to a certain point going, every time I go to the bank, it'd take me months to be able to get approval. It was just a lot of paperwork, and it was just frustrating. It's spending me a week to just try and get that, and I get disapproved and so forth. And I thought, stuff this, I've got cash sitting in the bank and I've got equity in my properties. I'll go out and find better opportunities where I can get between 20 and 30% return on my money rather than sit in the bank and just wait for the next, purchase of a property. Because ultimately, the reason why I see buying property, it's not necessarily to build this huge amount of wealth. You can have 20 or 30 properties and have, $10 million property portfolio. But if it's not generating income for you to live your life, generate a lifestyle and generate passive income for you not have to work or choose to work, then what's the point of building this large portfolio?
So many people are looking at the cash flow. I'm like, but you still have loans on these properties. Yes. Where's the cash flow coming from? There's not much left over after the repayments and all the outgoing. So it has to be the long-term play, because you need these properties paid off.
Absolutely. And that's the interesting thing. I mean, I spoke to a number of investors, and I know a few investors who have this massive portfolio that, worth 10, 20 mil and so forth, but they're still telling me that after all that time, they're still putting money in to be able to service this portfolio. And I'm going, wow, you've got such a large portfolio, but how is it possible that you guys still haven't been able to, have that possibly paid off, or, be able to service it by itself and have passive income? And it's just unfortunate because of the way the Australian property market is, because we're really good with capital growth and we provide a lot of equity, but we're very poor at providing cash flow. And that's what we need to live, to have that ongoing cash flow, because it's great if you have $10 million of equity, but if you can't utilize that 10 mil to generate cash flow, then what's the point? It's like, you got a golden goose, but doesn't produce eggs. So that's the reason why I started looking into it, and I started pulling out a lot of my equity and cash and reinvesting into this type of alternate strategy space where, as I mentioned, I'm generating like between 20 to 30% return, still secured by properties, but not me necessarily having to buy properties, and I'm working with a lot of great developments, because the thing is that there's a little gap in the market at this point in time where developers need some form of, quick capital. And because there's an ample amount of cash in the market at the moment, investors are willing to put it in there for that period of time to be able to get in and get out quickly. And I guess I might share the story about how I got into this, because that kind of will probably paint a backstory about why this is such a great opportunity for me anyway, and for a lot of the investors I work with. So I guess back in 2019, I was going to joint venture development with another developer, and it was a simple 1:2 lot subdivision with a renovation on the front of the house. It took approximately, supposedly, about a year for this whole project to be done, council approval, title, and put on the market. So 2019 April was when we purchased it. 2020 April, we put on the market to sell. Now, I think most people know 2020 April was when the pandemic hit.
Yeah, right on the cusp of when, yeah.
Right on it, exactly. And it was the worst timing ever because the market just went quiet. And we had already been told weeks before that the property market was booming. We'd make an extra 100K on that deal and it'd be fantastic. And then it all just went crap. So basically, we had to, I guess, change the strategy, and it was basically a waiting game. We had to wait to see what the market would do, and eventually we did sell them out after, say, 12 months because it took that long. But unfortunately, we didn't make any money because by the time we sold it, all the profits were eroded. The investor got his money back without an issue because he had a fixed return, and we promised him we'll pay his return back, which was great. But for us, we spent literally 2 years without earning a single cent because we put a lot of hard sweat and tears in it. Now, luckily, I wasn't just involved in only one deal because I'd like to diversify and make sure that I spread my risk across different deals. So around about 2019 in November, I was also offered another deal to invest into with my own cash for a 1:4 lot subdivision down in Victoria. And all I had to do was basically just put capital in. And what happened was the reason why they were seeking for that funding was because even though they had a full funding, they had no issues and they were ready to move forward to development, one of their relatives, close relatives, passed away, unfortunately, just all of a sudden. So it wasn't right for that developer to go ahead and use her money, and they just returned it back to the family. So that's where I came in that really short period of time because they needed it literally in 2 weeks. And I said, great, I can do it and happy to fund it. Now, interestingly enough, 6 months later, which is around the same time as when COVID hit, roughly in April 2020, he came back to me. And this time around, he said to me, look, whatever I've offered you for a 12-month period, I'm willing to pay that 12-month interest, that we agreed upon, because a developer has actually offered to refinance and pay us out completely because it looks like such a great deal. And I said, well, for sure, I'll take the money. If you're offering the same thing that you're going to pay me in a year, pay me in 6 months, I'll take the interest and I'll take my principal back. And it was beautiful. So, true to his word, came back and got paid out. And that was my first experience of what we call a type of alternative investment, which was basically a lending, of my own capital and having a fixed rate of return on that. And it was a fixed term as well. So it wasn't like, going to take me 24 months, wait till the end of the deal and exit. I actually knew that I'll go to exit within either 12 months or 6 months, whichever term was first. And that was my first experience of being refinanced out. And hence, that's the reason why I kept doing more and more of these deals. And since then, I've done more than 12 to 15 of these type of deals in the last 18 months. And they've been extremely, extremely, successful in the sense that we've been able to just compound this amount of capital to continue to grow the portfolio. And rather than wait for a bank to provide me another loan, I just keep rolling these over and just build up my capital base much, much faster and getting a very, very good passive income from that as well.
You're your own bank now, have you?
Yeah, pretty much.
You got a funding line and used, and you've kind of turned the table on the banks going, look, I can do it my way and get a better rate of return on your investment as well.
Yeah, because I think the downfall, and this is maybe something that listeners might be interested in know, is the banks take too long. They've got too much bureaucracy, red tape, and sometimes the process of a simple loan can take anywhere between 6 to 8 weeks. Whereas if we can get investors together within a couple of weeks, the developer's going to obviously take the quick one because they're losing money every day by not having the project finished. So it's a win-win situation for everyone.
So can people work directly with you, Tyrone, on these type of deals? Or do you have like a criteria for people, other investors to partake? How does it work from your perspective?
Yeah, simply they just reach out to me. We have a conversation and then see if it's a right fit for them. And then, we can go from there. It's pretty much as simple as that.
Yeah, okay. Is it a case of, you got great returns from what I've seen, so is it a case of high risk, high reward, or is there some type of safety net for investors? Because obviously there's a couple of ways. One is they do it themselves and put it into one property. There's, diversify and buy a couple, or go something for a higher rate of return, but there's always an element of risk. So from your perspective, where do they sit on that kind of spectrum, mate?
Yeah, it's really interesting. I think there is also a misconception that the fact is people think, okay, because you're getting a higher rate of return, that they'll be more risky. And sometimes it is that case, and that can be true. But based on what we've revealed and seen with all these deals, there's nothing for us to hide. We're very transparent about it, is that we're actually just meeting a gap in the market. And essentially, if the developer was to actually go to the bank or to another private lending institution, they would be paying very similar kind of rates, but it take a lot longer time. So what we've done is that we've just sped up the process, so it made it faster for them. And the reason why they're willing to pay these kind of rates to us as investors is because we're actually helping them move forward to the project. Because if it's only going to affect them, like we're not lending the whole development, we're only lending a proportion of development, it averages out maybe an extra 1 or 2% on top of their current interest that they're paying to their bank. So
but for that's the pain and time they can avoid, it's kind of worth it on the upside to them, because they want speed, isn't it?
Absolutely. And that's probably the reason why, for me, when I look at it, because we're getting a security, this is not like, you're just putting money into a trust and you pray and hope that someone's going to pay you back. You're actually registered as a mortgage on their security, which is their property. So it'd be their development. And if something does go wrong, you as an investor have access to that property to sell it down to be able to get your return or your investment back. So that's why if you actually do due diligence behind this and you understand the metrics behind it and how it all works, it's actually a very, very low risk strategy. And, I'm happy to say that because I've done it so many times. I think
and then you put your own cash in as well, which kind of there's skin in the game from that perspective as well.
Yep, absolutely. So that's why I think ultimately you can either put your money into buying property that you can own, and you get maybe a 5 or 6% yield on your property, or you can, invest into development that is going to add value anyway and get a high return. Now, I'm not going to say do this all the time. You got to obviously diversify, which is what I've done. I've got a property portfolio. I've got these alternative strategies, but it's a nice way to be able to sort of fuel and speed up the process. Instead of having to wait 20 years to buy and hold lots of properties, you can actually slim that down to maybe 5 years or something like that, because you're accelerating your capital growth much faster.
Fantastic. Thank you very much. I really appreciate you sharing that. And what we'll do is we'll include your details as well. If anyone's interested, want to get in touch with you, Tyrone, more than happy for them to reach out to you and see if this is the right opportunity for them, as that suits part of their portfolio as well. And just want to be very, very clear that any information that we do share and give is not intended to give advice. So do make sure that you do speak to your planner or your accountant to make sure that you are given that right advice that suits your needs as well. But Tyrone, to have someone of your ilk and of your experience, I just want to kind of heartfelt thank you to say, really appreciate your time and appreciate you sharing, being such an open book and sharing as much as you can with us as well.
You're welcome. Thanks so much, Aaron, for inviting me onto the podcast. I guess I'll just add, for people who are really interested in these type of alternative strategies, just feel free to hop onto my website at propertyinvestory.com. Just download a free report. It actually goes through and tells you step by step, how this works. So as I said, I'm very transparent about this. There's nothing to hide. It's open for people to actually learn about. And if you're interested, just feel free to reach out to me. And thanks so much for listening as well.
Thank you very much, Tyrone. I'm sure we're going to get you back on at some point in the future and find out how you're tracking, how you're progressing as well. Because when we talk about alternative strategies, I'm sure people's ears will prick up going, give me something else as well besides the normal buy and hold strategy. So, mate, thank you very much for sharing. I really appreciate your time.
You're welcome. Thanks so much, Aaron. Nice to talk to you as well.
You too, mate. That's been another episode of the Australian Property Investment Podcast. If you found that helpful, please drop us a comment, drop us a line and say, you've enjoyed the show. And like we mentioned, we will include Tyrone's details below. And until next time, take care.